Imagine two people sitting at the same coffee shop. One is 25 years old in 1995. The other is 25 years old today. They both have jobs. They both work hard. They both want the same things: a comfortable home, financial security, maybe a family, and enough money to eventually stop working. But their financial worlds are completely different. The person in 1995 is thinking about saving for a house, putting money into a retirement account, and slowly building wealth over decades. The person today is checking stock prices on their phone, buying fractional shares, researching crypto, watching financial videos online, and wondering whether a traditional path to wealth even works anymore. And this raises an uncomfortable question. Did Gen Z change investing because they are impatient? Or did investing change because the world around Gen Z changed? For decades, the financial formula seemed simple. Get a stable job, save money, buy a house, invest for retirement. Wait, but millions of young investors looked at that formula and noticed something strange. Housing prices had climbed faster than wages. Education had become more expensive. Inflation reduced the value of money sitting still. And the financial tools once reserved for professionals were suddenly available to anyone with a smartphone. A generation that grew up watching economic uncertainty started asking a different question. Not just, how do I save money? But, how do I stop falling behind? This is the story of why Gen Z is investing differently, and why their approach reveals something much bigger about the future of money. To understand Gen Z investing, you first have to understand the environment they entered. Every generation builds financial habits based on the world they experience. People who lived through economic hardship often valued safety and savings. People who experienced strong economic growth often trusted traditional paths. But Gen Z grew up in a world of contradictions. They saw incredible technology and opportunity, but they also saw financial instability. They watched markets crash, recover, and reach new highs. They saw people build businesses from laptops. They saw digital currencies appear almost overnight. They watched ordinary investors access information that used to belong mostly to professionals. And most importantly, they saw that simply earning money was not always enough. Imagine someone earning $50,000 a year. If their salary grows slowly, but rent, food, transportation, and housing costs rise faster, they might technically be earning more money while feeling like they are moving backward. This is where investing became more than just a retirement strategy. For many younger people, investing became a way to protect their future. Previous generations often thought about investing as something you did after becoming financially stable. Many Gen Z investors see investing as something they need to do in order to become financially stable. That one difference changes everything. It explains why younger investors are more likely to explore stocks, index funds, cryptocurrencies, side businesses, and alternative assets. Not because every investment is smart, not because every trend creates wealth, but because they are searching for leverage in a world where the old financial milestones feel harder to reach. The question is whether this new approach creates opportunity or creates a completely new kind of risk. Consider two people, Alex and Jordan. Both are 22 years old. Both graduate, start working, and earn similar incomes. But they see money in completely different ways. Alex follows the traditional path. Every month, Alex saves whatever is left after paying bills. The money stays in a normal savings account because it feels safe. No market crashes. No confusing investments. No risk. Jordan takes a different approach. Jordan keeps an emergency fund, but also starts learning about investing. A small amount of every paycheck goes into diversified investments. Some months, the investments go up. Other months, they fall. At first, the difference looks meaningless. After 1 year, Alex has cash in the bank. Jordan has investments that move up and down every day. From the outside, Alex might even look smarter, because safety is visible. Growth is not. But something starts happening quietly in the background. Over time, Alex's money faces an invisible force: inflation. If prices rise over many years, the same amount of money buys less than it used to. The number in the account may look the same, but the purchasing power can shrink. Jordan faces a different problem: volatility. The investments sometimes lose value. There are moments of uncertainty. There are times when patience becomes difficult. One person risks losing purchasing power by avoiding risk. The other accepts certain risks to potentially build wealth. And this is the financial challenge Gen Z is trying to solve. They are not choosing between risk and no risk. They are choosing which type of risk they are willing to manage. The deeper truth behind investing is that money is always moving, even when it looks like nothing is happening. Imagine putting $10,000 under a mattress. 10 years later, you still have $10,000. It feels like you preserved everything. But if everyday costs have increased significantly during that time, that money may buy much less. This is purchasing power. And understanding purchasing power is one of the biggest reasons younger generations think differently about money. They do not just ask, how many dollars do I have? They ask, what can those dollars actually buy? This is where assets become important. An asset is something that has the potential to create value or increase in value over time. A business can produce profits. A stock represents ownership in a company. Real estate can provide housing value and potential income. But assets also come with uncertainty. Prices change. Markets become emotional. Trends can create bubbles. And this is where some young investors face danger. Access to investing has never been easier. A person can open an app and buy an investment within seconds. But easy access does not automatically create good decisions. The same technology that allows someone to build a diversified portfolio also allows someone to gamble on hype. The difference is understanding the mechanism underneath. Compounding is one of the most powerful examples. Imagine someone invests $300 a month. Not a life-changing amount. But if that money grows over decades, the returns can start generating their own returns. The growth begins slowly, almost boringly. Then years later, the curve starts changing. Because time becomes part of the equation. This is the hidden advantage young investors have. Not necessarily more money, more time. But time only helps when combined with patience, consistency, and reasonable decisions. Starting early can be powerful. Starting early with poor choices can also create years of mistakes. The tool itself is neutral. The outcome depends on how it is used. Now fast forward. 5 years later, Alex and Jordan are approaching 30. Alex has built strong saving habits. That discipline matters. But rising living costs make progress feel slow. Rent is higher. Groceries cost more. Buying a home still feels difficult. Jordan has experienced a different journey. There were bad months. There were market drops. There were moments when investing felt like a mistake. But the habit continued. The investments had time to recover and grow. Now move forward 20 years. The difference becomes much more visible. Small choices that looked insignificant in someone's 20s can shape options in their 40s. A person who builds assets may have more flexibility. They may have investments helping with retirement. They may have more choices about where they live or how they work. A person who never invests may work just as hard but find themselves depending only on their next paycheck. This is why wealth is not only about income. Two people can earn the same salary and end up in completely different places. Because wealth is also about what happens to money after it is earned. But the story is not as simple as investing makes you rich. Life is unpredictable. Markets do not move in straight lines. Some investments fail. Some risks are not worth taking. And sometimes the smartest financial decision is not chasing higher returns, but avoiding a mistake that could set you back years. The biggest difference with Gen Z is not just what they invest in. It is how early they are having the conversation. Money, investing, inflation, financial independence, and wealth building are no longer topics people discover at age 45. Millions are thinking about them at 20, and that could change the future. So why is Gen Z investing differently? It is not because an entire generation suddenly became obsessed with stocks, crypto, or financial apps. It is because they entered a different financial reality. A world where information moves instantly. A world where opportunities are easier to access. But also a world where mistakes can happen faster than ever. The old financial rules were built for a different environment. The new financial tools are still being tested. The answer is probably not rejecting everything from the past. And it is probably not blindly chasing everything new. The strongest approach takes lessons from both worlds. The patience and discipline of traditional investing, combined with the curiosity and adaptability of a new generation. Because building wealth has never really been about predicting the future perfectly. It has been about understanding change, protecting your choices, and making decisions today that your future self will thank you for. Every generation has a financial challenge. Gen Z's challenge is learning how to build wealth in a world where everything moves faster. The question is not only how much money you can make. The bigger question is, will your money be ready for the world that comes next?